$100 to $300 added to your monthly mortgage payment, and the CFPB new rules might be why. If you think the CFPB mortgage regulations won't significantly affect first-time homebuyers, you're not alone. Most people assume these regulatory changes are just bureaucratic noise. But here's what the data actually shows. According to the CFPB own press release and analysis from mortgage industry reports, the new regulations could trigger a 0.5% to 1% increase in mortgage rates for certain borrowers. That's not a rounding error. For $250,000 home, that's roughly $1,500 to $3,000 per year hitting your monthly payments. By the end of this video, you'll know exactly which borrowers face the biggest impact, why rates are climbing, and what you should do before you apply for your next mortgage. Let's start with what changed. The CFPB recently tightened mortgage underwriting standards, specifically around debt-to-income ratios and qualified mortgage rules. On the surface, that sounds technical, but here's where it hits your wallet. Lenders now have stricter guidelines for who qualifies and under what terms. Research from the Federal Reserve indicates that tighter lending standards historically correlate with higher rates for marginal borrowers, typically those with credit scores between 600 and 720 and down payments under 20%. Here's the first concrete number. If you're putting down less than 20%, you're entering PMI territory. Private mortgage insurance typically costs 0.5% to 1.5% annually on your loan balance. A $200,000 loan at 1% PMI is $2,000 per year. But under the CFPB new guidelines, lenders are more cautious about who they approve for lower down payment loans. That caution gets priced in as higher rates. Data shows first-time homebuyers with 10% down payments have seen rate increases averaging 0.75% compared to the previous 12-month average. Now here's where it gets worse. The CFPB new qualified mortgage rules require lenders to verify debt-to-income ratios more rigorously, meaning they're looking at every credit card, car payment, student loan, and personal obligation you carry. The threshold is typically 43% debt-to-income. If you earn $60,000 annually, that's $25,800 in maximum annual debt payments before you're disqualified. Most first-time buyers don't realize they are already close to that ceiling. Student loan debt is the culprit for 73% of first-time buyers under 35 per Federal Reserve data. That compressed borrowing capacity forces lenders to offer higher rates to offset the perceived risk. Let's put a real number on this. Imagine you're a first-time homebuyer earning $75,000 annually with a $200,000 student loan balance and $350 in monthly car payments. Your debt-to-income ratio is already 37% before the mortgage. The CFPB stricter verification now flags this immediately. A lender used to offer you a 6.5% rate on a $250,000 mortgage. Under the new rules, you're looking at 7.21% to 7.25%. Over 30 years, that's a difference of roughly $200 to $250 per month, $72,000 to $90,000 over the life of the loan. The timing matters because mortgage rates are already climbing. Current 30-year fixed rates are hovering around 6.8% to 7.1% according to Federal Reserve data from recent weeks. The CFPB tighter standards are compressing that further for borderline borrowers. If you're on the fence about applying, the smartest move is to lock in rates sooner rather than later and to clean up your debt profile now before you apply. What should you do? First, pull your credit report and calculate your real debt-to-income ratio. Get every monthly payment listed. Second, consider paying down high-balance credit cards or auto loans before you apply. Even a $5,000 reduction in debt can lower your ratio by 0.8% and potentially save you 0.25% in rate. Third, talk to a mortgage broker who understands the CFPB new rules. Not just a bank loan officer. Brokers often have access to lenders with different risk profiles. The bottom line, the CFPB new regulations are real, they're measurable, and they hit first-time homebuyers hardest. A 0.5% to 1% rate increase doesn't sound dramatic until it shows up as $200 more on your monthly payment. If you're buying in the next 12 months, act now. If this changed your perspective on mortgage timing, hit subscribe. I'm covering refinancing strategies in the next video dropping Thursday. What's your biggest concern? Rates, qualification, or down payment savings? Drop it in the comments.